Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. We hope you had a very nice Father's Day celebrating with family and loved ones. We are back into the new financial week, and there's some stuff we got to talk about. First, we got to talk about last week's Fed decision. Remember, we talked about them bringing a 50 basis point or 0.5% rate change to the table, and that it could be even 75 basis points, and some people floating 100 basis points, which would be an entire whole percent move just in one decision. Now, what we saw was the 75 basis point decision, which is 3/4 of a rate on the Fed funds short-term interest rate. Now, immediately, the mortgage-backed security and bond markets reacted negatively to that, and rates went up very substantially. Now, they took a little bit of a breather on Thursday, and they kind of ended the week a little bit higher than where they started, but right now what you're seeing is the financial markets trying to figure out what's coming next. Now, the reason they're doing this is because the financial markets understand that there are a couple of tools in the Fed's tool belt that they can use to help with monetary policy, managing inflation, job and wage growth, and right now there is a definite lack of confidence in some of those tools working to solve the problems that we're facing right now. So of course what that means is everyone's kind of looking around wondering, when's the other shoe going to drop? Is the other shoe going to drop? When will it drop? Which one will it be that drops? And no one really knows quite for sure what the next challenge and headwind is going to be when it comes to Fed monetary policy and our national financial system. So for mortgage and real estate, of course, this means that we're dealt the hand of dealing with the rates that we are at now. We are comfortably in the sixes for a fixed 30-year loan right now. And it is our personal belief that we're going to be hanging around here for a little bit. You know, everyone was kind of, ramping up ready for their Fed decision last week, and their next decision won't come until July. So we do have a little bit of time between now and then to kind of sit in this, I'll say, no man's land before we determine exactly where the next direction is going to be and how long we'll be heading in that direction. And just like you, it's kind of surreal to be sitting here and talking about mortgage rates that are almost twice as expensive as they were just 6 months ago. But this is the reality that we faced, and I think we have to tackle it head on. So let's talk about a couple things right now. The first thing is, remember, if you're trying to buy a house right now, you are buying this house for longer than the next 24 to 36 months. Do not measure your decision today on what you saw the previous 24 or 36 months look like. You need to measure your decision based on what is right for you and your family and the duration you plan on staying at that house. The other thing to remember is the Fed will have to course correct again in the opposite direction at the point in time where they've determined they've gone too far in this direction. Looking over the hill a little bit, I've talked about this before, where I envision in a couple of months down the road, maybe even a year down the road, we're gonna see things ease up again, because when you over tighten monetary policy so that it helps bring down inflation, you eventually stop spending so much that money isn't moving through our system, and money moving through the system will only be kickstarted again when it becomes less expensive for people to borrow from the banks. Now, in short, what that means is there's going to be lower rates ahead. I just don't know exactly when that's going to be, and no one in the market does, because right now all this has to get sorted out first. The dust has to settle, and then the Fed can kind of regroup themselves and figure out, okay, now that we've solved this problem, where are we at now? And then what areas of the financial industries can we ease up our tightening so that lending can flow again and we can get the appetite at lower rates than what we had to do over here that we did to combat inflation. For those of you who have a lot of equity in your house and you're looking at how I can get that equity and I can pay off some of my debt, I can get myself through the next 24 or 36 months, you are probably going to be looking at this situation a little more with a little more discretion, trying to determine what's the cost benefit of taking your equity out now versus letting it ride as house prices are kind of starting to flatten off a little bit. I'd say be very cautious and watch the house prices here locally in San Diego. We are not yet seeing them turn, but we are starting to see a lot more buyer discretion for the houses that are on the market. And you're gonna start seeing that sellers who are in a pinch or they need to sell for other reasons other than the top of the market being the top of the market, they're going to slowly start making some concessions that sellers have not had to make in the last 24 or 36 months. So keep your eyes open for that now. I might be a little bit early on this, and that's okay. I'm not saying it because you're gonna see it happen like this week or today. I'm just saying that coming up, you're going to probably start seeing some sellers that have to sell start making a little bit of concessions. That doesn't necessarily mean the gate's going to fly open and there's going to be 1,000 buyers at every open house again. I don't think we're seeing that, but there is definitely more discretion by buyers being exercised right now than there was just a couple months ago. So for those of you who, back to the refinance situation, who are looking to take cash out, while prices are still at these elevated tops and they are going to flatten out a little bit here, this is the right time to even consider it. It may not be right for every single one of you watching this, but if it is something you need to consider because your budget is tight and you're paying all these other consumer debt balances every single month with high interest payments, that is something you should consider now while your equity is still high. Now, if this is not the right time to do that, we're going to tell you. The math will show you whether it's in your favor or it's not in your favor. Simply having a conversation and asking us about it to kind of work out a scenario is definitely the right thing to do. And then ultimately deciding what to do or not to do should overwhelmingly be convinced by the math itself. So I think from this point moving forward, when we do Monday Mortgage Minute, we're going to talk a little bit more about like what's going on, why it's happening, where we think we're going. But also I want to make sure I reiterate this point. You know, we've been at this business for 16 years. So we've been through the collapse of 08 and 09, the rebuilding years, and here right now after this massive boom we had for the last 2 years. So there's some staying power at this place. There is a lot of industry knowledge, there's a lot of firsthand experience, and we've closed thousands of loans. So it is likely that a situation you might be facing, we've already seen before, we've already crossed that path, and we've already had a solution for in the past. If you're watching this and you're hesitating, well, maybe I shouldn't say anything, or I'm not sure if I should, I'm a little embarrassed to talk about my situation, please don't be. We've helped a lot of people who felt that way come to a conclusion on whether they should or should not take action on their mortgage so that they could get to where they need to be as a family in their finances down the road. Also, I know that there is a lot happening at like the national level talking points of where we're at, and I know I talk about some of those things too, but always remember that what's happening here in our local market is what's most likely to occur in your neighborhood. So as we digest all these talking points and where we're at economically, remember that what's most likely to occur to house prices and equity and rates is all really a concentration of what's happening here locally first. Even if there are some downward federal pressures coming to our area, remember that the resiliency of any one particular area is mostly defined by that area. Now, that is it for this week. As always, please feel free to share this video with someone you know, like, and trust. And if you have any questions, please leave us a comment, send a DM. Please reach out and talk to your loan officer and ask them how they can help you during this time. There is no bad question to be asked. And if we have a solution to help you, we want to make sure you know about it. And you can also just ask us for advice. If you just need someone to talk to and bounce ideas off of, just reach out and let us know. We don't know how we can help you unless you tell us. So please reach out. We look forward to hearing from you. We look forward to helping you. Thank you and have a great week. We'll see you again next week.